Good morning. I'm Steve Brobeck, and I'd like to welcome you to the Consumer Federation of America's 14th Annual Consumer Financial Services Conference. Somewhat to our surprise, the theme of this conference, the consumer in the financial services revolution, is really as relevant today as it was in the mid-1980s, perhaps even more so. In the past year, there have been profound structural changes. The biggest bank mergers in U.S. history were announced, including one between a bank and a financial services company. Also, several major insurers announced plans to demutualize. There have also been important changes in financial services products and how they are sold. Most notably, credit products ranging from subprime mortgage loans to credit cards to payday loans were priced and sold much more aggressively. There was also intense debate on several public policy issues. After the U.S. Supreme Court ruled that credit unions could not organize affiliated groups, Congress decided that these co-ops should have that ability. Congress also nearly reached agreement on far-reaching financial services modernization and on new restrictions on personal bankruptcy, but never actually passed measures that both houses could agree to. While we don't have time to discuss all these issues today and tomorrow, we have selected topics we believe to be important and timely. Many involve public policy issues. In a session this morning, a new no-fault insurance proposal will be debated. After that, the need to regulate bank mergers will be discussed. Then this afternoon, a new mortgage proposal by federal regulators will be examined. So will the value of life insurer self-regulation. Tomorrow morning, concerns about subprime mortgage lending will be debated. Debt management and wealth building will also receive much attention. They will be addressed respectively by our luncheon and opening keynote speakers, and they will be discussed in the final session tomorrow morning. Of course, the need for most Americans to build wealth depends to an extent on the future of Social Security. Different reform proposals will be evaluated this afternoon. I want to thank members of the Conference Advisory Committee, listed on the last page of your program, who helped CFA plan this conference and cover its expenses. And I would also like to thank Adele Ellis, who managed all aspects of the event. Now I would like to turn the program over to Katie Sloan. She will introduce our opening keynote speaker, Arthur Levitt, whom CFA believes to be the most pro-consumer chairman of the Securities and Exchange Commission in that agency's history. This is because, in my opinion, Mr. Levitt strives to serve the broad public interest, not some narrow special interest. Katie?
Thank you, Steve. Good morning. It is an honor to introduce our keynote speaker this morning, Securities and Exchange Commissioner Arthur Levitt. It is a privilege to have him with us today. Without question, he is one of our nation's most committed and concerned leaders. He came to the SEC after having served as chairman of the American Stock Exchange for 11 years, and before that, having gained much experience working on Wall Street. When Chairman Levitt came to the SEC, he established 4 priorities for himself: improving investment protections, reforming the municipal debt markets, raising the standards of practice for brokers, and strengthening the international preeminence of U.S. capital markets. In his tenure at the SEC, he has made it clear time and again that the SEC would stand up and speak out for investor protections. A major move in this direction occurred when he led the SEC in establishing the Office of Investor Education and Assistance, and thereafter created the SEC Worldwide website. I know that our chairman, Senator Howard Metzenbaum, would be here today if he were anywhere in the Washington area. He and the chairman are good friends, and he joins me in welcoming Arthur Levitt to our program this morning. We are pleased to have you with us.
Thank you very much, Katie, for a very warm and generous Welcome. I'm really delighted to be here today. This conference, and more importantly, your efforts to inform America's investors recognize one undeniable truth of our time. An era of institutional reliance is ending, and an era of self-reliance has begun. Our markets in America are the glory of the world, and journalists and others revel in talking about America's supremacy in terms of capital markets. What I have recognized from my life's experience as a broker, as someone who has run a large brokerage firm and a significant stock exchange and now the head of a regulatory agency, is that our markets are a function of investor confidence. And when that investor confidence diminishes, so do our confidence in our markets, and so does our supremacy in terms of globalized markets. Nancy Smith, who heads our investment education division, is a terribly important factor in the new SEC, an SEC which cares passionately about the interests of investors and our commitment to protecting investors. I used to say in different parts of my life that a good broker was one who placed the interests of his investors above his own, above his firms, and above the industry. And I view among the many constituents that the Commission serves as the most important constituent, the one that we view in terms of every single issue we deal with, is America investors. And that whether we're talking about market regulation, whether we're talking about enforcement efforts, investment management, or anything else the Commission does, how does it square with protecting investors? Now, today, more and more of us are taking responsibility for our own retirement needs. And in that process, savings and investment habits have been dramatically transformed. More Americans are investing in stocks today than ever before. More than 1 in 3 American families now invest in mutual funds. That's more than 35 million households. And fund assets today at nearly $5 trillion now exceed insured commercial bank deposits, which stand at only 2 4/10 trillion. Now, back when nearly all of us saved at a bank, bought whole life insurance, or had defined benefit plan, the responsibility for investment decisions, of course, was in somebody else's hands. And that's really no longer true. By entering the significantly less certain arena of our capital markets, more than 50 million investors have assumed higher risk in the hope in America of gaining higher reward. Now, that kind of change didn't happen overnight. Indeed, it's been the better part of this century in making. Wall Street was actually really a private club until World War I, and the war effort was credited by the first SEC chairman with creating a vast number of security holders. He said that from a few 100,000 before 1916 who held securities, more than 20 million became investors during the war, mostly in war bonds. Now, as dramatic a change as that was, it involved government bonds, which are certainly among the most secure investments. Americans, by and large, continue to shun the stock markets, and the Depression served to reinforce that risk-adverse philosophy. For decade after decade, Americans were conservative savers focused on keeping money in federally insured bank accounts and maintaining life insurance. And this transformation is how Americans save and invest and it has enormous implications for our markets, for our economy, and really for our society as a whole. The plain truth is that there is an unacceptably wide gap between financial knowledge and financial responsibility. If every investor in this country knew the fundamentals of saving and investing, we might be talking about a totally different subject today. But we really know that we don't have that luxury. You recognize the challenges we face, I'm sure, as well as I do. Tens of millions of American investors lack the basic saving and investment information that they need to prepare for their retirement or to organize their own financial goals. More than half challenges we face, I'm sure, as well as I do. Tens of millions of American investors lack the basic saving and investment information that they need to prepare for their retirement or to organize their own financial goals. More than half of all Americans have never even tried to figure out precisely how much money they're going to need for their retirement. Too many people don't know how to assess the risks of the different financial products that are out there today. And we have more financial products today with greater velocity than ever before. Now, what do I mean by greater velocity? The products we have today, if they go amiss for one reason or another, have a much greater consequence faster than traditional stocks and bonds had in the past. I'm talking about derivatives, options, a whole host of products of that kind. Now, too many people don't even know how to assess the risks of those different financial products. Too many people really don't know precisely how to choose an investment or even how to pick an investment professional that's going to help them make these important choices. Now, while 63% of the American public know the difference between a halfback and a quarterback, only 12% know the difference between a no-load and a load fund. That's pathetic. Millions absolutely don't understand the purpose of diversification. Millions have market expectations that are absolutely out of sync with reality. Is there any doubt that we're in the midst of a financial literacy crisis? Now, earlier this year, the SEC, the Consumer Federation of America, and a national coalition of government agencies, business groups, and other consumer groups launched the Facts on Saving and Investing campaign. And our goal is to motivate Americans to get the facts they need to achieve financial security and to avoid costly mistakes. Even if the government had all the resources and power in the world to protect investors, I know there's no better way to prevent fraud and abuse than to educate investors. I'm absolutely amazed at the capacity of Americans to deny facts that are right before them and to fail to equate risk and rewards. In Orange County, where the average returns for funds of the kind being invested on behalf of investors in those Orange County bonds were showing around 4.5% when Orange County was offering double that amount. Why didn't anyone raise their hand and say, there's something wrong here? The scams that we see every day at the Commission, where investors bought into an internet scam to the tune of nearly $10 million on a scheme to invest money in a non-existent eel farm, where an internet site that I picked up a few weeks ago offered 300% annual return. Guaranteed. Guaranteed by whom? And yet that soaked up millions of dollars of investors that went down the drain. The campaign that I spoke of isn't only about improving investor knowledge. I think that's half the battle. Earlier, I said that more Americans than ever before, from every stripe of life, from every activity, were investing in our markets. We know that we need to reach out to those investors to help ensure that they understand the relationship between risk and rewards. We know that this is a critical element of making suitable and sound investments at the right time in their lives. But what about those tens of millions of investors who aren't investing in our markets? What about the 90% of Americans who could contribute to an IRA but simply don't? What about 1/3 of our population who could participate in an retirement plan but don't do so? Plainly put, what are we going to do about those Americans who simply aren't saving? About a month ago, the Commerce Department reported that the personal savings rate for October was in negative territory, minus 0.2%. I was saddened to learn that that was the lowest since the Great Depression. I have a lot of stats that I could throw at you. Few, however, trouble me more than the one which the CFA uncovered. 65 million American households will probably fail to realize one or more of their major life goals because they haven't developed a basic financial plan. Shouldn't it be incumbent upon every one of us to get across to all Americans from every income level that saving early and investing over the long term is not only smart and sound, but increasingly essential? Shouldn't a lower wage worker hear the importance of saving and investing just as often as a recent college graduate? Shouldn't a worker in a textile factory know how much he or she needs to save to retire comfortably just as much as a worker in a high-tech factory in Silicon Valley? I know that as far as this group is concerned, I'm preaching to the choir. I know Senator Metzenbaum and Steve and Barbara have made the importance of saving and investing for all Americans a clear and unambiguous goal of the Consumer Federation of America. As we move forward, the efforts of consumer groups are going to play an indispensable role in educating more Americans about retirement options. And one doesn't have to be an expert in the consumer interest movement to recognize the great influence it has upon our lives. Whether looking for a dependable car or a safe toy for our kids, the right health plan or the right foods, the consumer movement has made all of our lives better. But I have noticed that many consumer groups have traditionally stayed away from financial services issues. I don't think this is surprising. In the past, our capital markets have been viewed as the sole province of the wealthy. Today, it has never been more clear that investing and saving for one's retirement is just as much a pocketbook issue as buying a car. And I see this in our investor town meetings as we travel around the country, asking groups of investors to come out and talk to us about questions that they have, about problems that they're experiencing. At the beginning of every meeting, there's a reluctance. People are embarrassed to admit the level of their own illiteracy. They feel their brokers or advisors have some special knowledge they must not question, that those views are kind of Olympian coming down that they have to blindly follow or reject. And then when one person asks a question that they kind of feel is a dumb question, the others come out and ask other questions that aren't quite as well-founded, perhaps. But there is no such thing, in my judgment, as a dumb question. I've dealt with investors all my life, and I think the greatest shortcoming they have is an unwillingness to admit their own fallibility and the unwillingness to question conventional economic wisdom. I invite all consumer interest groups to join the Facts on Saving and Investing campaign in spreading the message about saving and investing. Your voice and the voice of other groups is absolutely critical. And I believe that history will view the latter part of this decade as the beginning of the next, as a time when one of the greatest influx of new and inexperienced investors entered our markets. The proliferation of defined contribution plans and new technology no doubt will continue to bring new investors into the market. Will this be heralded as a time of great opportunity and a time that spearheads the growth of America's economy? Or will it be looked at as a period when millions of investors were duped, were fooled, were misled, went down paths that were inappropriate? I guess I fear that the range of investment and savings options may confuse and overwhelm many current as well as potential investors. Choosing among thousands of stocks, bonds, funds, and insurance products can certainly be a daunting task. And before we ask Americans to make informed decisions, they need to know three things. They need to know what their investment goals are, when they're going to need their money, and most importantly, how much risk can they afford? Only then can they choose investments that match objectives. Consider the influence of the Internet. Today, an average individual investor has more power and information available at his fingertips than ever before. You, as investors, can go online, push a few buttons, and risk hundreds of thousands of your dollars. Investors now have access to information that up to a few years ago was available only to securities professionals. And the amount of information available on the Internet is simply mind-boggling. If you were to click through 10 new financial websites a day, you could keep going for 2.5 years before you exhausted all the possibilities. Turn on the TV, the radio, or open a newspaper, and you'll see advertisements for mutual funds, each with their own 5-star rating and 2, 3, 4, or 5-year performance histories. How many of you have seen advertisements for the growing number of Internet stock trading services? Could I see a show of hands? How many of you have been at home eating dinner, and sometime between 8 o'clock and 10 o'clock at night the phone rings and some broker that you've never heard of badgers you about some investment? Could I see a show of hands? Yeah, me too. Well, there's a word for that I can't use in polite society, but that's something the Commission cares a lot about, and that's a real problem. That's preying on investors. But if you turn to any of the financial channels, you're going to find some expert talking about earnings forecast for Company X and breaking news about Company Y. It's no surprise that investors don't know precisely where to begin. During my years on Wall Street and at the Commission, I've learned one all-important lesson for investors. 2 words: ask questions. And if you're not satisfied or you're still confused, more questions. And for heaven's sakes, you don't invest in what you don't understand. If every saver and investor in this country inquired, peppered, or even annoyed someone in the position to answer questions, I've no doubt that many people out there would be meeting their financial goals, and far fewer investors would lose their hard-earned dollars. Together, we need to give people the tools to ask the right questions and to get the right answers. How do we do it? I think there are several things we should do. First, has anyone here heard about the importance of saving from either listening to the radio or watching TV? I'm sure we have, but we've all heard the important warning that friends don't let friends drive drunk. But we don't hear as often that friends don't let friends squander their financial future. I think we should hear that message more on TV and radio. Second, companies should take a greater role in teaching their workers about money. I think the failure of companies to educate their workers will be looked back upon as a financial disgrace. Employers that provide financial literacy programs are more than repaid through higher worker morale, greater productivity, and lower employee turnover. Third, I applaud the efforts of our partners to expand financial literacy instruction in the schools. This spring, many partners in the Facts on Saving and Investing campaign will showcase their school programs. Today we stand at what may be a defining moment in America's economic history. This may someday be described as the era of democratization of American finance. But if the vast majority of investors are not informed, not invested, not educated, opportunity will lose out to ignorance. I don't think we have a second to waste. The time to act on all of this is now. If you sense some urgency in my voice, I think it's for good reasons. As some of you may know, a few weeks ago I discussed the implications of investing Social Security in the stock market. Clearly, we're concerned about closing the knowledge gap that exists among investors today. But it becomes even more of an imperative if we adopt individual accounts as part of overall Social Security reform. With individual accounts, more than 140 million American workers would be investing their retirement accounts in securities. Increased risk through greater choice holds the potential for greater returns. That's the upside of a system of individual accounts. The downside is that uninformed investors often won't be in a position to capture that potential. They risk making poor decisions, perhaps through ignorance or because they fall prey to fraudulent advice or misleading sales practices. Or, more importantly, they simply don't understand what they're doing, and the consequences of that can have a significant emotional impact. How many individuals do you know that have made an investment in the market, and I'm sure they're here in this room, and it may have been the first investment, and then they look in the paper the next day and they see that stock is off an eighth or a 16th, and they begin to worry. And they emotionalize investing, which is the worst mistake you can make, both in falling in and out of love in our markets. But whatever happens, one thing is certain, that the face of our financial system is changing and will continue to change. And more of those changes are being driven to meet investors' needs. Take the Commission's Plain English initiative, for instance. Today, when a prospectus or other investor document is submitted to the SEC for comment, one of our most important considerations is whether you and you and you can understand it. And if you can't, we're going to throw it back to them. There's no reason that the language has to be arcane and mysterious. The lawyers of America are trying to convince corporate issuers that only they can interpret the language that goes out to America's investors. But there are enough lawyers and enough corporations today that are willing to take the chance and get on the bandwagon of plain English to make a difference. And we at the Commission, who for years and years have used our own form of gobbledygook, are changing that as well. Years ago, the problem was a lack of information. Today, it's a glut of information. Prospectuses must work for investors if they are to thrive in our new world of information. With the influx of new investors, we've got to concentrate on connecting with the great volume of information that's out there. And I see plain English as an example of the type of positive change that comes from a wider circle of participation in our capital markets. If the number of investors had stayed relatively static over the last decade, consumer-driven interest to spur changes like this would have been rare, and companies would feel far less pressure to improve their communication with the investing public. But But today we have a unique opportunity before us to help generations of Americans make the most of their God-given potential. Whether one person actively saves and invests or another fails to put away a penny, they both fundamentally share the same goals. Who would argue that every American worker doesn't have the basic right to retire comfortably? Who would argue that a parent doesn't want to be able to send their child to college? Who would argue that any person doesn't want to provide the health and the security that every family needs? No one would. We should always remember that most people don't invest just for the thrill of getting in on the hottest new IPO. Most people don't buy one stock in the morning and sell it in the afternoon. Most people aren't betting that bond yields will fall during a certain time period. Most people invest and save for a very simple but immeasurably important reason: to safeguard their retirement years, the futures of their children and their children's children. America has always guaranteed opportunity for anybody willing to work for it. But if people don't invest and save over the course of a lifetime, they deny themselves security and opportunity, and that's a tragedy. Working together. I can't think of any more important mission than reaching out to every person in this great country and offering opportunity through education, empowerment through participation, and security through responsibility. I look forward to joining with this group and others who share a common interest as we work together toward these essential goals. Thank you very much. I can answer just a couple of easy questions. Yeah.
You talked about consumer education. What about the legal rights of investors against unscrupulous brokers and financial advisors? Do you think they've been watered down of late? And how would you strengthen the legal rights of investors?
Well, I think our system is remarkable in that it provides for private rights of action, a commission whose principal goal is to protect investors, largely through its enforcement efforts, and third, the work of the self-regulatory organizations that have their own regulatory programs. We are working very hard to anticipate and stamp out as much fraud as we possibly can, but I don't kid you in the expectation that we will eliminate all of it. It's up to investors to learn how to protect themselves and to use their legal rights in the case of being defrauded. But this commission regards protecting investors as their most important priority, and we will continue to work toward that using our enforcement efforts and using our regulatory arm, as well as supplementing it with providing investors with the means of protecting themselves, which ultimately I think is the best protection. Other questions? Yes.
What about the possibility of putting gross commission dollars earned by brokers on brokerage statements? How would that square with the best interests of the consumer in your view?
I was looking at some internet sites provided by leading brokerage firms yesterday, and I think they're much clearer than the statements that I saw when I was running a brokerage firm. I personally believe that the question of brokerage compensation has created certain conflicts which make investors have less confidence in the professionalism of their brokers than they should have. And I'm heartened to see the industry moving more toward fee-based compensation, which is more visible than commission-based compensation. As to whether they should go on brokerage statements is a function of are we putting so much information on those statements already that they're just so hard to understand? I'd have to think about that some more, but clearly investors should know what they're paying in commissions, and the movement toward fees makes that clearer. Yes?
If vast amounts of Social Security money were to enter the market, would that not have an inflationary effect on the market?
The question was, if billions of dollars of Social Security money went into the market, would that have an inflationary effect? I think we have to think very carefully about the impact of how Social Security money enters the markets in terms of what kinds of structural impact it would have on our markets. I think that can be contained, but it depends how it's done. It depends what system you use. It depends whether you have government investing the trust fund, whether you have groups of advisors handling discrete portions of that, whether investors do it for themselves. So it's hard to answer that question, but I think it is manageable. Final question. Yeah.
I do a fair amount of employee education toward retirement, and one of the things that I run into fairly often is people who don't have basic math skills, who even when I am trying to get them to do an exercise looking toward retirement and give them a calculator and try to get them to calculate a percentage return per $1,000, and I've recently had a 50-year-old-ish person just push the calculator away and say, I don't do those things. When we've got a working population where an awful lot of the people are in that kind of a situation, how do we get those people to manage investments?
That's a very good observation, because so much of the language of investment is mathematical. But having said that, I believe that the most important kind of judgment an investor can make is to assess his or her own tolerance for risk, and that's a judgment that people fool themselves about all the time. They don't really answer that, and they get caught up in the emotion of a recommendation that a friend makes or money that somebody else is making. Another very good benchmark is an investment doesn't come out of the blue. It generally, and most frequently, comes from a person talking to a person. Is there trust? Is there really trust and understanding? I cannot begin to tell you how many investors that I have had personal experience with that after telling them about an investment and what it means to watch their heads nod, total understanding, yes, they want that, and then when I've asked them, do you understand what you're buying, they haven't the slightest idea. How many of us are embarrassed to say, repeat that, I don't know what you're talking about when you talk about an annual rate of return or an internal rate of return. Mathematical skills would help, but a kind of intellectual boldness would help even more. It's a good question. Thank you very much.
Thank you, Chairman Levitt, for a wonderful and inspiring keynote address. I think we're going to move right into our next session.
Yeah.